Welcome back, everyone. Michael here with Offshore Citizen. Today we're going to give you an update on some of the possible or proposed tax changes that the Biden administration is bringing into the U.S. I've talked about this previously, some of the things they were discussing on the campaign trail, and I think the general idea is that Biden's plans are worse than what he had proposed on the campaign trail, or at least what looks like may come out may be worse. So we're going to discuss that. Before we do that, if you haven't already, please hit the subscribe button, nail the notification bell, make sure you don't miss out on any of our future videos. I try to produce great content for you every single day. And if you're interested in help with international structuring, either moving abroad yourself or moving your business abroad, either strategy or the implementation, please reach out to us. You can book a call with me, calendly.com/Michael-Rosmer, or you can check out our websites, offshorecitizen.net, offshorecapitalist.com. What we are talking about today is mainly around the GILTI tax. So of course there's always domestic tax things, but for our purposes we're always interested in international tax. And for those of you who aren't familiar, what happened in the 2017 Tax Cuts and Jobs Act, the Trump tax changes, were, among other things, they introduced this thing called the GILTI tax. And prior to that, it used to be quite easy to get around the rules and at least defer income abroad for American companies, okay? GILTI tax made that super difficult to do. And it's really quite disingenuous how they say it. Like, I was just reading an article through Politico, I think it was, and they were mentioning, oh, you know, taxing on intellectual property intangibles like patents. The truth is this covers most income. So for example, if you have a service-based business abroad, you're subject to GILTI tax in almost all cases. Basically, the only way you can get around that is if you have tangible assets. So as opposed to it being just going after, you know, intellectual property and things like this, it goes after everything except for tangible assets, which is kind of not so good. Anyway, right now, the way that it works, and I've done some videos on this, if you're interested in kind of the way to do international tax planning for Americans, you can go and check it out. The tax rate is basically half of the regular tax rate at the GILTI level, so you pay 10.5% tax, okay? Now, here they're proposing to do two things simultaneously. Number one is to raise the corporate tax rate, and they're proposing 28%, which is what they'd proposed on the campaign trail, so fair enough. What they'd said during the campaign trail was that maybe they should raise GILTI tax to 21%. Now there's some proposals suggesting that they should raise it to the full corporate tax rate. And so that you can understand how punitive and stupid this is, you have to understand that US companies would basically pay, so if they had a foreign subsidiary, so already US companies pay whatever. It's just when you have a foreign subsidiary, then the foreign subsidiary can potentially benefit from a lower tax rate. And why does this make sense? Well, because you're already paying tax in that other country and you're already having to compete at that level. If we say, oh, hey, yeah, but you know what? You're also going to have to pay this tax here, or if you're competing with local companies that have a lower tax rate, yeah, you have to pay that tax as well. Right now, it's around 19%. If you pay that in the foreign country, then you don't have to be subject to GILTI tax, which of course is, you know, pretty high rate. If, for example, you were operating in Ireland, 12.5% tax, no GILTI tax would apply to you, and so on and so forth. So this is not a very good thing, okay? Now, in this scenario, what they're suggesting is that the full tax, they would potentially raise the corporate tax to 28%, and they would potentially charge the full amount. Now, what Biden is saying is, okay, you know, 3/4 of that was the original proposal. So basically, whatever the corporate tax comes in at, if it comes in at 28, then divide it by, or multiply it by 0.75, and you get, you know, what they would charge for this. This is pretty bad for Americans. And one of the things that I think they don't get is the extent to which businesses and people can move today. I can tell you, I have more people contacting me in the past year about leaving the US, about renouncing their citizenship, than I have ever seen before. For years, we've had it where Americans would contact us and say, okay, you know, they're interested in structuring. But now it's like, yeah, get rid of the citizenship. Can I buy a new one? Like, this is becoming a very popular thing, and it makes sense because it's just like, what are you getting out of it, you know? So anyway, that's like a big thing. And here's the next part that goes along with that. So what happened when they brought in the Tax Cuts and Jobs Act was, although they lowered the corporate tax rate down to 21%, which is a big drop, however, it was not a drop that was out of order compared to the rest of the world. It's about the European average, about the OECD average, okay? In spite of the fact that they did that, they, at the same time, eliminated the deductions for state tax. Okay, now this was bad for people who are, say, in California, because what it used to be was, okay, you could get this state tax deduction, and so it would work out not so bad. What they're proposing here is they're proposing, hey, we're going to keep eliminating all those deductions, and we're going to raise taxes on you. So anyway, very terrible. I hope they don't do it. I mean, it's probably good for, I don't know, the rest of the world if they do, because that will do more to push entrepreneurs abroad. But I think just increasingly what you're going to see is they just don't appreciate how much the world has changed and how much things are slipping out of their grasp. And I think the cycle that you'll see in these types of countries is they're going to try and crack down more and more. And as they try and crack down more and more, it makes people leave more and more, which means there's less revenue to pull on, which means they have to take more from the people who are left. And of course, that's a losing battle. So anyway, I hope that kind of helps, fills you in a little bit on what to maybe expect if you're an American. I think if you are in a position where you're doing tax planning right now as an American, you should be thinking not about what the taxes are this year, because you're already into this tax year anyway, but what the taxes might be next year. And you should probably plan on the idea that you're going to have a higher corporate tax rate, 28% as opposed to 21%, and there is a decent chance that the international tax rate goes up quite a bit, and that could be pretty bad for you. So what do you do about that? That's the real question. You could either move abroad, right? Or you could engage in using some sophisticated trust strategies or something like that. But bottom line is, it's increasingly less attractive to be an American operating through American companies. Hope that helps, and I'm going to look forward to seeing you guys on the next video. Before you go, if you liked the video, please give it a thumbs up. And if you have any questions, put them in the comments below. If you have suggestions for other content, we'd love to hear from you. Put those in the comments below as well. And I'm going to see you soon.